Hi, I'm Yusuf Mowlana, Portfolio Manager of the MNG Equity Fund and MNG Property Funds, and today we'll be speaking about some of the trends that we're observing in the property sector and how we see those unfolding over the near term. I think a lot of people were pleasantly surprised by the performance of the South African property sector last year. Certainly 2020 was a very poor period for property returns, and it was great to see some recovery. We are seeing a number of new emerging trends, some of which are a continuation of trends which existed prior to COVID, and some of which are somewhat new and I think maybe here for a couple of years. So the first thing is there has been prior to COVID a trend towards convenience that remains in place. We are seeing greater spend going to grocers as opposed to apparel retailers, for example, and the trends of department stores underperforming line shops and smaller store formats, that seems to still be in place. But in some cases tenants are trading above pre-COVID levels. And in certain categories, categories that are COVID affected, those are still trading actually below COVID levels. So, net, we're slightly above pre-COVID levels in some cases, but there is divergence among tenants. So I think perhaps one encouraging point during 2020 is that very, very few companies undertook deeply dilutive rights issues. Most of them actually, tried to retain earnings through dividend reinvestment programs, disposals of properties, or just very small capital raises. And I think that has encouraged us in terms of the prospects of returns, because clearly management could have destroyed a lot of value at the bottom, but they didn't. So credit to a lot of management teams. We are seeing, in many cases, elements of consolidation, which was long awaited by market participants. So during the last year, just over last year, RDI REIT was taken private. Arrowhead and Fairvest have merged. Hyprop has made an offer for the Highstead assets, or the portion which it doesn't own. And then Irongate Properties in Australia is subject to a buyout, which has been recommended by the board. So quite a lot of activity happening in the sector, and I think it is exciting times to be invested. So I think what excites us as active stock pickers is that there's great divergence both in the valuations of the companies and also the fundamentals. So as per the slide which is in front of you, you can see that there's a large divergence between expensive companies like Sirius Real Estate, which trades at large premium to its book value, and then a company like Attack, which trades at less than half its book value. And clearly, we're not necessarily saying we should buy all those cheap companies or sell all those expensive companies, but I think the divergence in valuations gives one an opportunity to stock pick and sift through the noise and try and find good investments. I think investors observing the negative reversions, i.e. the lower rents which the retail landlords are accepting in the current environment, would ask, where's the bottom and where do rents actually bottom? Now, if we go back in time to 2019, 2020 and 2021, during that period, retail landlords had, for the most part, accepted quite deeply negative rental reversions. And on the understanding that most leases tend to be maybe no longer than 4 or 5 years, in our view, we have perhaps another 2 years of negative rental reversions, after which we may see positive rental growth. And the chart in front of you shows actually what's happened to trading densities indexed to 100 in 2016 versus a theoretical rental escalation. So escalating rents for 7% per annum from 2016 and comparing that to the average trading density growth observed by the retail landlords will show that rents have escalated far in excess of what the underlying trading of the tenants has done. And that has necessitated these negative rental reversions. But we think because retail landlords have already taken some pain, there's only a very limited number of years ahead where we'll see those negative reversions, and certainly the quantum will come down as trading improves. Now, if we go over to the office sector, in contrast to the retail sector, which has managed to maintain quite low vacancies through this entire period. The office sector has unfortunately suffered from increasing and higher vacancies, and that in turn we think will lead to an unlikely return of any kind of rental tension in the market, because tenants have their pick of the best space. And we've used Growth Point's office portfolio as a proxy for the office market, and Hyprop's retail portfolio as a proxy for the urban retail market. And there you can see quite stark differences. In general, the office sector has been less well occupied over time than the retail market, and for that reason, rental growth has been worse than in the retail market. So this is quite an interesting chart. I think a lot of investors who are invested in the retail property market would want to understand how online retail affects brick and mortar retail. And one of our largest holdings is Nepi Rockcastle and also Mass. And what we've done is to model, if online took a certain amount of market share and consumption growth grew at the given rate, what would that mean for brick and mortar sales? So in the first scenario, we have online retail sales going to 21% of the market, and then retail consumption growth at 5.5%. And what that means for store sales is that you're still able to achieve very healthy and very positive brick and mortar store sales of 4.4%. In the scenario where online retail only goes to 15% of the market, i.e. takes a lower share, and you're able to grow consumption at 5.5% again, then that means that your brick and mortar sales are actually that much better. So a lot of it depends on actually the pace at which consumption grows and the pace at which online retail takes market share. But I think what's very interesting for us is that for the most part in apparel retailers, online sales are actually not profitable. So they do it reluctantly because the customer demands it, but it's not something that they would necessarily actively push, unless they thought they could gain some kind of advantage by it. So hopefully one can see that in property we're still in for an element of recovery in the retail sector. The office sector will still be a bit slow. What excites us in the portfolio is some of the opportunities for the specialist companies like storage, which is one of our high conviction overweights. And then, on valuation grounds, we think that the sector is inexpensive to fair value. We do pencil in at least inflationary type growth over the medium term, which means that given the starting dividend yield, one should be able to beat bonds very slightly over the medium term on a risk-adjusted basis. And then if there is some sort of silver lining from the last 2 years, is that property values having gone lower should reduce development activity in the sector, and over the medium term that does support stabilization of fundamentals and rents, which is of course great for the sector. We do think stock selection remains very key, so a razor focus on leverage, the rental levels of the market versus the passing rents, and then focusing on underlying cash flows as opposed to accounting earnings. And then finally, the divergence in fundamentals and valuations provides opportunities for stock pickers. Thank you very much for listening. I hope you found the information useful. If you do require more information, please visit our website or give us a call, and we'd be more than happy to assist.